Good morning, traders. Chris Bus here with Traders Profit Compass with another edition of Before the Bell, your home for actionable pre-market content for Monday, April 11th. It is 6:32 a.m. as I'm starting the video. And as always, run your player at 1.5x. Quick look at futures. Bitcoin down 3%. Oil down 2.5%. Large caps and small caps are pretty much flat. With the NASDAQ down between 0.5 and 0.75%. Over on the macro front, don't forget we've got Good Friday this Friday, and the market will be closed, so feed that into your plans for this week. Also, not a lot happening today, but tomorrow we've got a big CPI print, inflation print. And that could be a real wild one depending on where that number comes in. Also, we've got earnings season kicking off Wednesday with JP Morgan. And then rolling into Thursday, we'll have a bunch of banks reporting. I think Citi, Wells, Morgan Stanley. Quite a few names there on the blog. I've got the calendar if you care to look at all the other names. Also, as a housekeeping note, I've got a problem with my Traders Profit Compass email. So if you need to get a hold of me while I'm getting that resolved, you can send me a direct message on Twitter at Profit Compass. That's at Profit Compass on Twitter, and I'll get the message, because I have not been able to pull my my company email in a few days, and I'm having trouble getting that resolved. So hopefully I'll fix that here quickly. So let's get into it here this morning. Starting with our oscillators, we were up here in overbought territory, and as always, the oscillators stand undefeated. Once you get up in this range, you're truly on borrowed time as far as expecting the market just to continually go higher. It's usually going to reverse. It's just a matter of when, not if. And so we got the move down, and now we're in the middle of the range, not really predictive. But my expectation is that we will make our way down towards oversold in the minus 60 area. Whether that happens today, by the end of the week, or next week, doesn't really matter. We'll work our way down here. And then at this point, if you're in shorts, you're going to start to want to back out of those in anticipation of reversing. Now, one thing I want to tell you is I have not excluded from my mind the possibility that the Fed might come in early with a rate hike. So, for instance, if CPI tomorrow comes in at a sickening number, 10.1%. 9.75%. I mean, just an absolute stunner. Not, the last time it printed, we got a 7.9, and there was a reaction, but mostly the reaction was, yeah, we knew it was going to be higher. And if it comes in at 8.3 this month, it's not going to be a shocker. But if it's up in the mid to high nines, or we get a 10%, just jaw-dropping number, I would not be surprised if Monday, Tuesday next week, after the 3-day weekend, they don't drop a 50 on the market and just say, we can't wait another 3 or 4 weeks in order to move. We've got to do it now. So we'll wait and see what that number is, and take it from there. We have no idea, and I'm not saying that a rate hike is any kind of a given. Maybe that jumps up from 5% chance to 25% chance or 50% chance on a jaw-dropping number. So keep that in the back of your mind as a possibility. Moving on to this ratio chart between high beta and low volatility, we see that it continues to move lower. What does that mean? That means traders are favoring low volatility stocks, and high beta is not the place to be. And we've shown this chart quite a number of times. All your defensives are moving higher, and your number one, they're outperforming the indexes, and they're dramatically outperforming the high-tech, high beta names. Utilities racing, healthcare racing, staples coming back against discretionary, moving higher. Staples versus SPY moving higher. QQQ or SPY versus QQQ higher, meaning SPY is outperforming tech. And I can tell you, when we first started this year, and certainly moving into the February-March timeframe, we said that this is going to be the golden age of long-short trading, meaning moving from a regime of just always buying the dip to something a lot more muddled and confusing. And I can tell you, having some shorts in the book of tech names, bubble names, Ponzi names has really, really been helping. Whether you choose to do that, through the various ARC funds, and we'll look at those charts here in a minute, or you've specifically targeted, certain bubble names that you follow, or simply avoid them, not have them in your book, has been really helping you. And if you've clung to the idea that software's coming back, or you just want to hang out in the FATMAAN mega cap tech names, you're probably starting to feel kind of frustrated. So what's been working? Just all the defensives, and I'm going to throw out some names, not to say go buy these, but you'll get the idea. Costco, Walmart, all the grocery chains, defense contractors, managed healthcare, mega cap pharma, utilities, commodities, and gold miners have all been really working well over the last quite a number of weeks now. So I continue to think those are going to be the items that work in this environment, and certainly want to point you in that direction for the long side of your book. And don't forget, with this 3-day weekend, be thinking about, as you start this week, how much you want to have on the board as we come to Friday and that 3-day weekend. If you're saying, I want to take it easy over that 3-day weekend, then there's not a lot of point in adding a bunch of positions unless they're just, 3-day trades, adding a bunch of positions early this week only to take them off, Thursday afternoon, because you don't want to carry them over the weekend. Or if you're going to view them just like what I said, 3 or 4 day trades, that's fine. Just have an idea when you're going in. Am I adding this position because I want it longer term and it looks like it's going to work? or it's just a trade. So keep that in mind as you're positioning today. I'm going to go quickly through these levels. SPY, I think you can use the 50 EMA. It's still above the 50 and the 200, but actually a little bit above the 20. So it's held up pretty well. I think we've got a level here at 450 on the top and like 444 on the bottom. And I think those are going to be the levels that kind of dictate the next move. You can see it here. We've got a well-defined large volume over price bar here at 450, and then we've got the 50 EMA down here at 444. And I think wherever it breaks is going to be the next, will open the door to the next move. If we go down here somehow this week and break the 50, then that's going to open the door for probably a more pronounced move lower. We made several runs into this little gap. I don't show that we ever actually made it all the way to the top, all the way to 451 to fill it completely. Maybe these couple of runs here were good enough to call it good. I don't know, but I wouldn't be surprised if somehow they popped into this gap, made a run at this downtrend line, and then rolled over and started heading back down again. As far as I'm concerned, I'm not going to get too excited on the long side of SPY until price can take out this downtrend line. Now, if it can get up here and 452.5 and it looks strong, yeah, because then you can get long right there and look for a move back up to 456. And the simple fact that I'm not expecting that, you should put a little star by it in your notepad saying it'll probably happen. But anyways, we've got a little range here down to 444. You can see there were a lot of responsive buyers here for actually it went into days across here. So you've got a large volume over price bar here, and then you can see this value band that runs from 444 up towards 453. But then if you break below, then it gets a lot more choppy and a lot of little voids, but nothing really major till we start getting quite a bit lower. So take that into account. If price were to come down and lose 444, in my mind, that would be a good place to have a little duration on your, if you get short, don't do it for like during the day, although you can obviously do that. Get a little duration. If we were to break that today, maybe get something for Thursday and see if this doesn't work its way down over the next couple of days, because then you'd be able to put your stop like right above 444. And as long as you stay below, you should be profitable. And then if this thing starts rolling downhill, then you'll be in good shape over the next, the next few days. The Qs. Most important takeaway on this chart is the gap never got filled and price is below all the moving averages, which in your mind should tell you it's a bearish setup. We do have some support coming in here at 347.50, but in general, you want price to get above the moving averages. So what would be important here on this chart for the bulls is to recapture the 50 and the 20 that are both there together at about 354.50. So coming, recapturing this little dotted line that I have there, that would be important. You can see it here in gold is your 50 EMA. So if price can, recapture that, then you could use that as a level to shoot against on the long side, with the idea that price could come up here and fill this gap. And that's a pretty good sized gap. I mean, you got, that's about $4 there, plus the dollar between the 50 and the bottom of the gap. So you've got potentially $5 of upside there if price breaks higher, recaptures the 50, and then makes a run for the gap. On the downside, below 347.50, we've got this little trading range, a little void in the chart, but then we've got some more support coming in towards 340, 337.50 down this way. And, we can see those levels a little bit more clearly on the 30-minute chart. So that'll give you some levels to shoot against, either on the downside or, like I said, on the upside if it wants to come up and fill these gaps. IWM remains bearish. Why? Well, for the first thing, price is below all the moving averages. Second thing is price dropped below one of the largest volume over price bars that we have on the chart. So I think you're going to be short against 200 and see if we don't make a move down to the bottom of the prior trading range, down here towards 188. Here you see this lot of trading between 200 and 198. I'm viewing that as kind of like a flat flag, a flat bear flag. So we've got the impulsive move here as an A move, flat bear flag as a B move, and then a break below 198. If you measure that out, points, down into this 190, 189 type area. And, that would make sense technically, moving back into an old trading range after having broken out is always a bearish move. You don't always get the full move down to the bottom, but more times than not you do. So that's kind of my eyeball technical target down here at the bottom of the box for IWM. And you can see that line real clearly right here on the 30-minute chart. And you can go ahead and measure it out if you want, but here's this prior low back here at 191.50 that hasn't been tested yet. And then if you go even farther back in the chart, you'll find something down at 189 as well. If you're new to the channel, thank you so much for spending time with me this morning. I place quite a bit of effort into finding the right locations for you guys to trade against, and then it's all about execution for you after that. And speaking of execution, today on the blog site, in addition to a lot of extra information I think that you'll find interesting, at the top of every blog I try to put something about inspiration, something to go beyond just levels and technicals and stuff about the market, something to inspire your trading. And I think that you'll find the one today pretty interesting. And it's I don't want to tease it too bad, but it's something that a lot of people don't want to hear. And so read that, think about it deeply, and then see if it doesn't help your trading long term. It's not a quick fix, but it's certainly the work that needs to be done in order for you to find more success in your life and in your trading. So please take a look at that. And then if that sounds appealing to you, please hit the subscribe button and the alarm bell for more of my content. And then jump over in the show notes. There's a link to the blog site where you can drop in your email address. It takes 15 seconds. And then morning, noon, or night, whenever I send anything out, you'll get it right there. Easy for you to find and easy for you to take a look at. So thank you so much. And then pass the link along to friends and family, those in your trading circle that may benefit, to help me expand my viewership. I really appreciate that. And of course, longtime listeners and followers, appreciate your support. So coming into the FATMAAN names, Facebook, we had the big rug pull. We came down, we found a bottom, we bounced up to the 50 where it has failed. And now we're between the 20 and the 50, and the 200 is way up here. So I would be alarming like 220 where the 20 EMA is, and I'd be aware of this large volume over price bar here. You know, you drop down below 215 kind of thing, nothing's for sure, but I would be willing to make a bet it's going to come back down here to 185 and check these lows again down the road. Apple holding on to the 50-day right here that comes in at 168.50. I think that's going to be a key level on the chart, and you can see it lines up with this lower support area. We're sitting here at about 170. You get a break below 168.50, then things start opening up to the downside. You've got a large volume over price cluster here down at 163, and I think that would be the area I would be targeting if price made a break below 168.50. But in the meantime, these little interior levels have been working so well. I mean, you can just look at the price action. It finds these levels and bounces like right on cue. So they've been working really, really well. You know, I don't think you're going to get rich on a $1.50 move out of Apple, but they are locations that if you're going to shoot for something more, they have been working. So keep that in mind if you're an Apple person. Tesla, I think really the levels to watch, you know, if you're not in are 1,000 down here at this high volume node, and then 1,100. If price comes down here to 1,000 and it looks like it's going to hold, you can certainly get long there and look for a move back up towards 1,100. Or you can, you know, if you're bearishly inclined and you're just biding your time and waiting for a breakdown, I'd alarm 1,000, because if it does break down, I think you're going to come down to 900 pretty darn fast. There's nothing really in the charts here to hold it up. I think you're going to have people waiting and then stepping in down towards 880, 900, something like that. And if we go just quickly looking at the daily chart, here's your 1,000, which would be a gap fill to the downside. You've got the 20 EMA coming in right at 1,000. Then you've got the 50, and then you've got the 200. So from a chart perspective on the daily, I mean, this is one of the better charts you will find in tech. Why? Well, you got price above the 20, the 50, and the 200, and it only dropped below the 8-day last week. So, A, B, C could certainly be in the cards. What would throw a monkey wrench into that is breaking below 1,000, not being able to hold the 50, and then rolling down here into the low 900s or upper 800s down here at the 20. That would be bearish developments if that were to occur. Microsoft daily, you can see it's sitting right here at the 200. The most important levels, if you've been following along for a while, is this 305 was a major level in my mind. That was the original breakout level. We broke above, now we're back below. You've got a high volume support bar here at about 292, and then you've got the 200 that comes in at 295.50. If you're looking for a place to get long, if you're bullish Microsoft, you can be long against the 200, or you can be long against this high volume support bar here at 292.50. I think it's heading lower, just because it's while it's a good company and everything, it's in the wrong group. Tech has been underperforming, and even if you get something that doesn't break down, if it doesn't go higher, that's still kind of like losing, right? If you get something that you just you get in this area and then it just doesn't really do a lot on green days, and then it loses more on red days, while it's not quote falling apart, it's not really doing much either. So I'm kind of taking the approach that if there's something intraday, like you see a rally against a support point, you can get long as a day trade or something like that. But as far as swing trading or position trading, I'm staying away from tech on the long side. Amazon, we had this head and shoulders. We had the measured move. Measured move was accomplished. Now it's sitting here at 30.90. I think that's your clear pivot for today. Break below. You can see the targets marked. If it holds, get a kickback up towards 31.50. But keep in mind, you went below the 200, which is never a good thing. And you can see it here. We had the rally off the double bottom low, came up, but now, as you can see, price is below all the moving averages. Not a good thing. Bearish posture. I got a little line coming in here at 30.50, but my expectation at this point is to at least come down to this 29.50 area in the days, weeks ahead. And then we'll have to see if tech can regroup at that point. Google making its way lower down here at 26.60. That looks like it's a good pivot point. Notice where the high volume over price support bars are. We've got a prior trading range. You can see it here between 27.10 and 26.60. What you may see is a bounce in this area and some further consolidation, just like this was a consolidation before you get a breakdown or a rally. I'm looking for probably a little bit of a hesitation here on that first touch of a well-defined range. Looking at the daily chart, I mean, it's lost $200 in 4 days. That's a lot. We were at 28.60, and now we're back at the 200 at 26.60 in 4 days. So pretty bearish. It is clinging to the 200, which keeps things from being a total disaster, but it's got to hold this here. Otherwise, not a lot stopping it down below to come back and test these prior lows again at 25.20. Netflix, we had been watching this little rally, came up to the 50 and got rejected. So now lost this 360 area. I think it's going to come back down to 330 and test this low. So I would certainly, I didn't participate in any of this stuff. I did have the 50 alarmed. That alarm is still in place. If and when it could recapture the 50, then you got some real running room up to this gap, and with the potential of filling that gap. But until it does that, I think you want to be leaning bearish on Netflix. Semiconductors really rough, and this is part of the reason why tech in general is having a hard time. I mean, semis are a classic risk on, risk off type indicator. And we were at 280 at the start of last week, and now we're at more or less 250. That's a lot. $33 move. I mean, it's been fast every single day, right on down. So I think now you've got a slight pivot at 247.50. Whether we get a bounce here back to 255, we can look at the 60-minute chart, see what it's doing. In a well-defined channel, there is an open gap up here. You get a kickback towards 250. Maybe you get a gap fill, but if you get something back up to 254, I think that's another short to come back down here and test this prior low back here of 238. So semis are looking a little vulnerable even after the big rug pull. Here's housing. Continues to work its way down on the weekly chart. Housing, home construction. We've got a large volume over price bar here, down towards 55. I am in this trade, and there'll be a decision to make soon on ITB. I think we did have a bounce on Friday in the sector, so I certainly don't want to, watch all that disappear. I'm in the March contracts of puts, so I don't want to see some kind of kickback rally up here. If I get a sense that a reversal is afoot, I'll probably just close that out. One trade that went against me on Friday was XRT. I've been short, and there was a rally on Friday, so I really want to see XRT get back below 75 this week. I'm in the May 75-65 put spread, so I don't want to see this thing go back up to 80, 85. That would, I'm up, not a lot, but I'm up in that position. So it may be time for to recycle out of the trade and then re-enter it, but that's going to be more or less a game time decision. And I want to quickly hit ARC. I mean, I think they're going after it again. Big downtrend, rally to the 50 that failed, and now it's rolling over again in the ARC F. ARC G, same thing, big downtrend, rally to the 50, fail. I think breaking back up below this 43.50 is going to open the door back to the lows. ARC flagship, same thing, breakdown, rally to the trend line in the 50 and fail. In this case, I wanted to show you we're in a 64, 59, 54 butterfly that expires Thursday. And you see where the fat pay zone is going to be, and we're right above it. Now I want to tell you that these butterflies do not really expand their value till the very end. Like Wednesday, Thursday, you'll see an expansion. So, if we move down to, whatever we move down to, 59 today, you're going to see an you're going to see a gain, but the real gain will be as the rest of the structure, time decay, happens between. It's going to move faster and faster and faster. The longer this stays in this fat pay zone, the faster the time decay will really benefit it. What we don't want to have happen is some kind of all-out collapse where it just blows past that area and moves out of that pay zone to the downside, because once it gets past 54, we'll have a big winner that turns into a loser. So a lot of that's going to be finessing where that is. And what I would say is, if there's a break below 57 or wherever you want to do it, you could get some puts. 57 puts, and you can either do that for Thursday or into the following weeks, because we've got a low down here that needs to be retested at 52. So anyhow, I wanted to make a little comment about that. ARC W, same as all the others, rally to the 50 that failed. Now it's rolling back downhill again. I think it's going to test the prior low. And here's one quick setup for you. A couple guys in the trading room saw this one. Disney weekly sitting here on a shelf at 130. I think if you get a break of 130, it won't be a free ride or an uncontested ride, but I think it's going to find this next high volume overpriced bar here down towards 110, 115. Not looking so great. So let's wrap it up there. Look at your defensive names. Keep in mind, we've got CPI tomorrow. Then we got the big banks Wednesday and Thursday. Holiday shortened week. Put that into your narrative. And depending on how CPI comes in tomorrow, let's be ready for anything the following week with the potential of a surprise rate hike. So hope you enjoyed the video. Hope you got something out of it. This has been Chris Buss with Traders Profit Compass. Talk to you next time.